and welcome to Eye of the Needle, a new podcast from Columbia Threadneedle Investments that aims to demystify the world of investing and shine a light on the people that look after your money. I'm Mark King, head of EMEA Investment Content, and joining me as co-host is investment writer Jim Griffin.
Hello, and thanks Mark. In this episode we're joined by Nicolas Janvier, US Smaller Companies Portfolio Manager, and we'll be speaking to him about his life in asset management, as well as the various factors that are a feature of his investing world, from trade and tax cuts to technology and Trump, and other things that don't begin with the letter T. Nick, welcome to the podcast.
Thank you, Mark and Jim. It is indeed an honor to be a very first guest.
Thank you, Nick. Also in this episode, we'll be covering the ABC of investing, our 60-second challenge, this month in history, and 3 things to ask your IFA this month.
But before we get to any of that, Mark, let's kick off with a few questions for Nick and find out more about the face behind the fund. Nick, so let's take you back to your career aspirations. What made you want to become a fund manager in the first place?
Well, unlike a lot of people, I wouldn't say that I grew up dreaming about managing portfolios. I wanted to be a sportscaster. Parenthetically, I would say like a lot of former failed sportsmen. I couldn't do it, so I wanted to talk about it. But I studied journalism, and I really wanted to do broadcasting. But very late in my university career, I had the opportunity to spend the summer at the Charles Schwab Company. And that's the point in time where I really started to fall in love with investing. What that opportunity provided me was a chance to really sort of start to understand what it is exactly that an investor does. Yeah. And at its core, it's 2 things. It's one, trying to establish, is this a sustainable business model that's addressing a critical need? But 2, which is just as important, is the market, are investors valuing the future cash flows correctly? Mm-hmm. And I really fell in love with the intellectual rigor of doing those 2 things, and that's why I became an investor.
You make it sound quite easy, Nick, but it's anything but, isn't it?
No, I like to think that everything that we do comes back to those 2 things, but obviously below each one of those 2 items, there are lots and lots of things that you have to get your arms around and really try to understand.
Yeah, so it sounds like the early part of your career didn't follow the path maybe you thought it would, but then since you have come into the financial world, has it been a sort of smooth ride for you from then on?
No, I wouldn't say it's been a smooth ride. First of all, like all young people, I would say that I had a lot of dreams that after 3-4 weeks in the place, I would immediately start to manage a $10 billion fund. And it hasn't worked out that way. But one of the great joys of having been a part of Columbia Threadneedle is I've had the opportunity to work for the firm in many locations now. I've had a chance to work for us in New York, Boston, and now in London. So my career hasn't followed the path that I would have expected, but it's been an enjoyable and fun one.
That's good. You've changed location a lot, but what does a sort of typical day at the moment at work look like to you?
Well, it's interesting because it's always hard to define our days as typical, right? And that's one of the things that I probably enjoy the most about what we do, and that our days vary so much. But there are 2 things that remain very consistent in terms of a day-to-day. One is we spend a lot of time with portfolio companies or businesses that we're studying. We generally will visit with management teams, either here in our offices or at their place. And really what we try to do in a very robust and systematic way is try to understand the business drivers, try to understand the drivers of future value creation, the drivers of returns, cash flows, and profits. And then the second thing that's really consistent is we spend a lot of time as an investment team talking about those things. We really try to get below the surface and we challenge each other's assumptions. And we challenge each other's assumptions around why we think it's a good business and why we think the market is undervaluing it. And those 2 things are really consistent. And then, of course, like all working people, I have to do a lot of less enjoyable things like team meetings or compliance training, and things of that nature. But obviously those are really important and critical part of what we do as working people. So they clearly are important.
And when you mentioned visiting companies, you get information from actually going to see them that you just can't get from looking at a screen or from poring over reports and accounts and research?
No, at the end of the day, one of the things that's really important is to understand that behind that screen, behind that ticker symbol is an actual business, right? And that business is made up of people. So it's you do get a lot of information from reading company reports and talking to analysts, but there really is no substitute for being on the ground and talking not just to the management team, but to the line managers, and really try to understand the culture of the place, because at the end of the day, culture, while intangible, is a big part of what drives future value creation.
Yeah. Talking of culture, part of our culture here is always to keep the client in mind. Do you think about the client at the end of the chain, if you like, of the money you're managing as a fund manager?
No, I wouldn't say I think of them at the end of the chain. I think they're the very front of the chain. And I think one of the things that keeps you humbled as you do this is to realize that these are actually people's assets, and there's no greater honor, if you will, than somebody trusting you with what is one of their most important assets, right? And so in everything that we do, I think you keep the client at the forefront of your mind. And sometimes when it's a tough day, you have to be careful because you don't want to over personalize it. But at the end of the day, it's the client's assets, and you're entrusted with a great responsibility of taking care of that and helping them grow it so that they could achieve whatever it is that their goals and objectives are.
That's good. So just a few non-money rapid-fire questions, Nick, to give the people whose money you're looking after a little insight into you. Your favourite book?
My favourite book. I'm a bit of a nerd. I really like history. And so one of my favorite books is a book called In the Black, A History of African Americans on Wall Street. And the reason that book is so important to me is because obviously I like to have a good sense for who paved the way for me, if you will. And so that's quite a good book, and I actually read it just about every single year, and I've been doing it for about 20 years.
Wow, well-thumbed copy. Yeah. Favourite movie?
Anything Eddie Murphy in the early to mid 1980s.
Bit of Trading Places. Then.
Yeah, Trading Places.
We said pork bellies and orange juice. You would know exactly.
Absolutely, but my favorite one is Coming to America.
That's very good.
But also being a father of three kids, obviously Eddie Murphy in the 1980s is not always appropriate, but I've really fallen for Shrek. I think it's totally underrated. It's one of the best movie series around, I think.
Okay. Very good. And what about musically then, your favourite album?
Not a big music person, but I did grow up in the 80s and 90s, so I'm going to throw out a name that maybe not a lot of people would know, but there's a hip-hop group called the Wu Tang Clan.
Yes.
And so that very first album is still something that I play on my iPod quite a bit.
Yeah. An easier one, sports teams.
Favorite sports team, that would be my university football team, the Florida Gators. And if you look them up, they've won a lot over the years.
Recently?
Well, not recently. Way to stick the needle in me, huh?
Very good. Right, well, Nick, thanks very much for that. We'll be coming back to you later for more questions about US smaller companies.
We will indeed. Now, before we get you to take our 60-second challenge, it's education time as we explore the ABC of investing. Each episode, we're going to take 3 letters of the alphabet and demystify the jargon-heavy world of investment. So this episode, we're going to start where many alphabets do, with A, B and C. A is for active fund. This is a type of fund that has a manager at the helm, usually a team of analysts and researchers, who will select the assets that they believe will increase in value. Actively managed funds have the capacity to outperform other funds and the market as a whole. They're usually slightly more expensive than passive funds because investors must pay for the manager's expertise.
B is for bonds. Bonds are essentially a form of debt issued by governments or companies to raise money. Bonds promise a set amount of interest until the bond matures at a fixed date in the future. These are not a risk-free investment.
And finally, C is for CPI, or the Consumer Price Index. Now, this is the official measure of inflation adopted by the government in the UK to set its targets. When commentators refer to changes in inflation, they're usually talking about CPI. And inflation, of course, erodes the spending power of the cash in our pocket, which means we need our wages, savings and investments to be rising by the same or more to preserve their value.
So Nick, we just mentioned the CPI measure of inflation there. Why is inflation important to you and your job?
Well, one of the really important things, and this goes back again to establishing the sustainability of a business model. A good business needs to have the ability to offset inflation in the future. And so generally speaking, when you have a business that is addressing a critical need that is well positioned in their industry, they have pricing power, and pricing power is really important. So when we study our company's pricing power is one of the things that we seek out.
Okay, well, without further ado, we are going to test Nicolas Janvier's economy of language with our 60-second challenge.
Nick, you have just 1 minute to try and describe the area you invest in for our listeners, which is, of course, US smaller companies. Are you ready?
I'm ready.
Okay, good luck. Your time starts now.
Well, I think the most important thing is first we have to definitionally establish what it is that we mean by smaller companies. In the U.S. market, these tend to be companies that are generally between 250 million and 10 billion of market cap. So smaller, but definitely not small. And these companies tend to have a couple of things in common. The first one is, generally speaking, U.S. smaller companies tend to be more domestically oriented. So on average, 75 to 85% of profits coming from the U.S. The other thing that is quite good about the asset class is it's a very broad asset class. There are about 25 to 2,600 companies that fits this definition. So as an investor, it provides choice, and it gives you the ability to discriminate between good and bad businesses.
That's incredible. We had 9 seconds left.
Yeah, he was inside there. I wasn't expecting that. Excellent. Well, that's not a bad effort at all, Nick. Thank you.
Just inside the limit. Well done, Nick. Now it's time to take a step into the financial past to see what was happening in February throughout history. On the 26th of February 1797, the Bank of England issued the first ever £1 note due to shortages of metallic currency following the French Revolutionary Wars.
In February 1984, Michael Dell, who was just 19 at the time, founded his computer hardware company in Austin, Texas, using a £1,000 investment courtesy of his parents. Today, Dell has around 140,000 staff and combined revenue of $74 billion.
And on the 2nd of Feb 1897, Howard Johnson was born. For those of you scratching your heads, Johnson was an American entrepreneur who launched a series of motels, hotels and restaurants called, funnily enough, Howard Johnson's. The restaurant chain in particular, known as Hojo's, expanded rapidly to become the largest restaurant chain in the US, but apparently none exist today. Now, Nick, I distinctly remember eating at Hojo's restaurant myself on a family holiday in about, I reckon, 1983, 84. Were you a fan?
I remember Howard Johnson well, spent many birthdays there with my family. I can't say that I was a big fan, but my mother really liked it.
Must have been a rite of passage, Howard Johnson's birthday meal. I guess it's incredible that at least on the restaurant side, such a huge brand like Hojo's can just disappear like that. But in the current age of disruption we've got now, that's no brand's 100% safe.
No, I think we definitely are in the age of creative disruption, if you will. And one of the things that is really driving that has been the emergence of data and the ability to use data to better understand customer trends, to better understand what it is that people are interested in, and to more narrowly craft the offering to specific segments of the population.
Right, Mark, I think it's time to find out a bit more about how Nick approaches the world of investing with a second round of questions for him.
Okay. So, Nick, what's your outlook for US smaller companies in 2019?
Well, the very first thing, and remember I talked about the domestic orientation earlier. So the very first thing is for us to establish what it is, where it is that we think the economy is going in the U.S. And for us, right now, the Columbia Threadneedle in-house view is that we think the economy is on solid footing. The economy had a very strong back half of the year last year. While we're not expecting a 4% annualized run rate. Again, we do think that the economy should go at or above trend, which is somewhere in the 2 to 2.5% range. In that environment, we would expect small companies to be able to grow revenues in the 8 to 10% range. And if they're doing that, a little bit of operating leverage, that's how much of that revenue generation is going to become profit, should drive profit growth of something like 10 to 12%. So we think it's a good backdrop for U.S. smaller companies.
So when growth is on the cards, because any growth is positive, but markets aren't performing well, there's a disconnect there, isn't there, for people who don't understand investing very well?
Yeah, well, the most important thing, or one of the most important drivers, and if you're ever sort of looking at a company earnings report and it seems really positive and you're wondering, well, why is this company going down today? Why is the stock going down? You have to remember that so much of investing has to do with what are investors' expectations, right? So oftentimes you'll see company XYZ grew profits at 10% this year. That's quite good.
Yeah.
Well, if investors were expecting 12, 13%, and that's what was priced into the equity, then what you find is that the stock will often go down in that scenario. So it's not just, where are things today, but it's where are they relative to the expectation that investors had baked into the market.
And this goes back to you visiting companies, trying to tease out where the companies may be better positioned than you thought they were, etc.
Yeah, very much so. And it also goes back to this idea of trying to tease out how sustainable is this cash flow stream, and where do our expectations differ from that of the market more broadly.
Yeah.
How do you sort of go about cutting out all the sort of geopolitical noise that, if you read general press, that just seems to be coming at us in waves? Is it easy to cut politics out of what you do?
Well, I wouldn't say it's easy, but I'm really happy that you use the term noise, because what I think is really important is for investors to differentiate between noise and information. Yeah. So noise causes volatility. Noise is generally not very important in the long term, does not have long-lasting implications. Whereas information, when the government is passing some new legislation that will impact how businesses are positioned, that will impact the future cash flow generation of that business, that's information. Yeah. And as an investor, you have to pay attention to that, and you have to understand and factor that into your analysis. So it's not always easy to ignore the noise, but it's important to remember that we're not here to discuss politics or to really pontificate on politics, but it's really to try to understand how are the things that are being discussed, potentially how would that impact business models and cash flow generation.
And sometimes that noise becomes real. I'm thinking of the tax cuts. Trump has many policy ideas, some of which that disappear, some of which actually happen. And tax cuts was something that came through and had a real effect on your marketplace.
Right, yeah, and that's where, again, going back to this idea of differentiating noise from information, changing the tax code and changing the statutory rate for companies, that's information, yeah. Right? So if you look at how that impacted the market, smaller companies, I would argue, disproportionately benefited from that because those companies were in fact paying the mid-30s statutory tax rate, which is now down to 20%. So that's had a meaningful impact on company profits.
Yeah. Global trade, another sort of Trump initiative, if you like. That situation is ongoing, of course, but does it worry you at the moment or for this year?
I wouldn't say it worries me, but I would say it matters. And it matters for our companies because while I talked about the fact that the companies tend to be very domestically oriented, their supply chain is global in nature. And so if you are an autos company, as an example, steel is a very big input. And to the extent we have tariffs on steel, that's going to drive up the price of steel, and that's going to have an impact on your future profit margins and cash flow moving forward. Yeah. So there is, it is something that you have to pay attention to and you have to understand. But what you don't want to do as an investor is overreact. You want to try to get a sense for where are we today, where do I think this is headed, and try to understand how does that relate relative to the expectations of the marketplace, if you will, right? And of course, it's not an easy thing to do, but that's why we're here.
Yeah.
And do you see any other sort of risks looming on the horizon, or do you just wait until they actually occur and then try and deal with them? Or how do you approach that?
Our job is absolutely to be forward-looking.
Yeah.
So we are paying attention to risk to the global economy. If I were to look at the U.S. market specifically, the one thing that we're paying a lot of attention to is what's going on with interest rates, and specifically the pace of interest rate increases. And the reason that's important is because as interest rates go up, that has the potential to impact business activity. Yeah. So that's important. But the second thing, which is just as important, is when we talk about valuing the future cash flows, one of the ways that you do that is you use the 10-year Treasury as your discount rate. Mm-hmm. If that discount rate is going up, that means that those future profits are worth less today. So you have to factor that into how you value companies.
Yeah. So just to explain that a bit further, so if rates rise, it makes it more expensive for companies to borrow. So that's why business activity falls.
Yeah, and to the extent that capital is less available in the economy, you would expect that business activity would slow down. Now, it doesn't mean that you go into a recessionary environment. It just means that all things being equal, business activity potentially slows.
And last year, the US Federal Reserve, which decides interest rates in the US, they were sort of more hawkish, which means they were more aggressive in raising rates. Mm-hmm. But now, am I right in thinking they've turned more dovish, which means they're less inclined to raise rates?
I wouldn't say that they're more dovish as much as I would say that the Fed has been clear that they're data dependent, right? Okay. So what they're not going to do is raise interest rates just because they think interest rates are too low. But what they are going to do is follow the data and follow what's happening with inflation. And to the extent that inflation is rising at a pace that warrants them to raise interest rates, then they're going to do that. But if it's not, then they won't, right? But the Fed has been pretty clear that they're data dependent, and I think that's important to remember.
Yeah.
Good stuff. Okay, and lastly, Nick, then what would you consider your greatest success professionally? And is there anything you'd do differently if you could go back?
Yeah, that's a great question. One of the things that I take a lot of pride in is I really try to remember that ultimately everything that we do in life is about people.
Yeah, sure.
And one of the things that I do, that I've done my whole career is I've always been focused on helping the people who are coming behind me, helping the younger people, helping them to learn, helping them to develop, to mentor them. And after you've been doing this for a while, these young people are not so young anymore.
No.
They're all off doing good work. So I've been quite proud to watch those folks develop and become very positive contributors, not just in our business, but in other places of society. So I know it's easy to think about promotions and the different things that you've done, but I take a lot of pride in the people who I've helped along the way.
Yeah, no, it's very rewarding, yeah.
And I noticed Nick ducked the question on, is there anything you'd do differently if you could go back in time?
I probably would start doing this a little sooner.
Excellent. Okay, well, before we wind this podcast up, we're going to quickly look at 3 things you can ask your IFA this month. The first few months of the year are a great time to try and organise your finances. If you haven't already done so, create a household budget, get into a savings habit, and check to see if you have anything left over to invest for your future. An IFA will be able to help you with this.
Yep, and there are still a few weeks left of the current tax year, so if you're not already taking advantage of this year's ISA allowance in the UK, it may well be time to start squirreling away some cash for your future.
There's always lots of talk about inflation and interest rates, and not just in the UK. But with the prospect of rising inflation and rates comes the need to double check the rate you're getting on your savings, the returns on your investments, and what mortgage deal you're on. You may need some help, so always check with an IFA if you're in any doubt about your finances.
Well said, Jim. And that's it for this episode. All that's left is to thank our guests, Nicolas Janvier.
Well, thank you. It was really great fun hanging out with you folks today.
Thank you. And also thanks to my co-host for this episode, Jim Griffin.
You're welcome. Yeah, it's been good fun.
We'll be back next time and we'll have another fund manager to take on our 60-second challenge. If you have any questions or suggestions for the podcast, let us know at podcast@columbiathreadneedle.com. So until next time, thanks again for listening and goodbye.
Important information. Your capital is at risk. Past performance is not a guide to future performance. The analysis included in this podcast has been produced by Columbia Threadneedle Investments for its own investment management activities. Information obtained from external sources is believed to be reliable, but its accuracy or completeness cannot be guaranteed. None of Columbia Threadneedle Investments, its directors, officers or employees make any representation, warranty, guarantee or other assurance that any of these forward-looking statements will prove to be accurate. The mention of any specific shares or bonds should not be taken as a recommendation to deal. This podcast is not investment, legal, tax or accounting advice. Investors should consult with their own professional advisors for any advice. Issued by Threadneedle Asset Management Limited, registered in England and Wales, number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG. Authorised and regulated in the UK by the Financial Conduct Authority. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies.